Well, I don't know about you guys, but I'm ready to be done mostly with this semester. I have a feeling that while this was an interesting experiment, it didn't quite make it to the level of fun that I would have hoped. I mean, at least one of you guys could have got your friends to Zoom bomb me, but oh well. Don't bother trying it now. It'd be hard to get a flash mob going. So today, the main thing I want to do is kind of wrap up knowing that there was a reason that we talked about each of the topics we did this semester. May I assume that you can see the PowerPoint at the moment?
Yes.
Thank you. So due diligence is the terminology we use for, in the business acquisition world, basically doing your homework. It's the trust but verify end of business acquisition. Your target company you're interested in has given you financials, it's given you kind of information on their customers, information on their product. You've seen enough to enter into an agreement to purchase. Typically, that's called a letter of intent. And there are a couple different ways you can buy a business. One is the asset purchase from a business, or the stock purchase of a business. The difference being the asset purchase from a business means you're taking everything you identify that is important to actually running that business, whether it is intellectual property, customer lists, equipment, inventory, vendor agreements, employees, etc. But when you purchase the stock or the share, purchase the assets of a business, you don't get their history with regard to the potential where an old customer comes back and sues them. An old customer may come back and try to sue you after you did an asset purchase, but because you now just own all the materials and whatnot, the prior owners have to deal with any problems that may arise from this their past bad behavior. I'm assuming that if they're getting sued, there was some bad behavior. Now, in a stock purchase, you're effectively trading ownership for money, and all of the history of the company becomes your problem to deal with. So the first part, not going through slides yet, the first part of due diligence and the first part of business acquisition, after you've identified a reasonable target, is decide how you would buy it. So the first two videos that we're going to share today are from the perspective of a business broker who is helping somebody like us find, somewhat evaluate, but mainly find a company that is of interest. The next purchase, or the next video, is associated with the asset purchase of a company. For the most part, my advice would be to purchase the assets of any company you are interested in, not purchase the shares of a business. That way you are, in fact, protecting yourself from potential old problems coming up to haunt you. And it could be an old problem, not with a customer, but with a vendor. So with a stock purchase, if that company retains its own life and you now are just the owner of that company, a vendor who says you owe them money, well, you may still owe them money. So even though the prior owner made a purchase and didn't pay for something, there's no good way for you to get off the hook if that prior owner is unwilling to pay for something they hadn't paid for but said they had. So it could be a vendor problem, it could be a customer problem, it could be a tax problem. If the state comes back or the feds come back and say, hey, you didn't pay enough taxes in 2018. Oh, by the way, that is not a terribly long time for this to actually happen. It's not uncommon if the federal government or a state government is missing a tax return to only really tell you 1 to 2 years later when they get around to it. So first we're going to go to the information from a business broker. Yeah. All right, let's see. This should be okay.
All right, this was a great question. My name is Nathan Goldstein, CEO of Vested Business Brokers. We help people find and sell profitable, privately held businesses. For 10 years I've been saying that. Profitable, privately held businesses. I should run a contest, see if people could say that 10 times quickly. All right, the question of the day was the due diligence. Folks, this is the most serious part. Probably the scariest part for you and for the seller. Because the seller is disclosing to you all the financial information related to their business. And as a buyer, it's your job to make sure that whatever representations the seller is making is 100% truthful, correct, and accurate. Okay? So this is the most important time. And it's the time when you have to be the most serious entrepreneur about your deal. And dot the I's and cross the T's. You have to
so we can't understand anything. The volume is really low.
Help you, and we strongly recommend that you get a CPA with forensic.
I'm not sure I know how to make it any louder, so you may just have to go back and view it again because all of my volumes are turned way up right now. I will see if there is another. Yeah, all of my sounds are way up. Okay, so just know that if you go to modules, you have the opportunity to go back over this PowerPoint in addition to watching the recording. I will try the closed caption. We'll see how that actually works. I'll back it up a little bit and we'll try again.
All right, This was a great question. My name is Nathan Goldstein, CEO of Vested Business Brokers. We help people buy and sell profitable, privately held businesses. You know, for 10 years I've been saying that. Profitable, privately held businesses. I should run a contest and see if people could say that 10 times quickly. All right, the question of the day was the due diligence period. Folks, this is the most serious part of the deal. It's probably the scariest part for you and for the seller, because the seller is disclosing to you all the financial information relating to their business. And as a buyer, it's your job to make sure that whatever representations the seller is making is 100% truthful, correct, and accurate. Okay, so this is the most important time, and it's the time when you have to be the most serious entrepreneur about your deal, and dot the I's and cross the T's. You have to have a competent person to help you, and we strongly recommend that you get a CPA with forensic accounting experience, or somebody who understands small business. Get them in there. Make sure that the bank recs match the deposits, and that the invoices match the QuickBooks. And you'll get out there to do your due diligence, and you'll get comfortable with the numbers. For any reason you're not comfortable with the numbers during due diligence, you have two options. A, you can walk away from the deal. But if you really like the deal and you think you can improve the business, you could ask the seller for an adjustment in the price, because you tried to price it and you priced your deal based on his representations. If his representations cannot be proven, let's say, for instance, a guy says he's making 200 and you only get 150, well, that extra $50,000 could dramatically affect the price of the business by hundreds, if not more, thousands of dollars. So you have to be conscious of that when you're doing your due diligence. You can't just agree, I'm going to spend $300,000 on a business that's really only worth 200, because instead of the guy saying that he was making 150, he's only making 100. So be conscious of the multiple, and be conscious of the due diligence, making sure that you can prove all the numbers that the seller's representations represent. I wish you luck. Be patient. Deals aren't easy, but they're worth the time and effort. Thank you for joining me today.
So one thing you should know, there are a lot of business brokers in every, metropolitan area. And they are kind of like real estate brokers on a, but not for houses, obviously. And they will facilitate you meeting with a business owner so you can express the interest in their business. That broker will advertise the business the way a realtor advertises a house, and they will do some of the work with the business seller so that when they identify you or somebody like you as a potential buyer for that business, they will already have some of the information you need to decide, do you take the next step? Do you continue to have an interest in this business? When he talked about how much a seller wants for it, a business, and how much a buyer is willing to pay for the business, it's very dependent on you seeing that everything you've been shown is in fact correct. One of the businesses we're looking at right now, the owner has taken and used funds from the business to remodel his own house. Now, his money, his business, his decision, but when it comes to valuing that business, for all intents and purposes, it looks like he spent an extra $20,000 to $30,000 each year in maintenance within his business, even though it was used outside the business. From a tax perspective, that's kind of a no-no. And paying him back for the work he did to his house isn't sensible as a purchaser, but rather paying for what the business is worth based on the financials, based on the tax returns as presented, knowing full well that he could have made more money on selling the business. That's something that you need to be cognizant of. Let's go over to the other video, which is the asset sale of a business. I am always amazed at this video because the lawyer seems to have decided that he should have his monitor up above him. So he's always looking up. I don't know why. So here we go. Let's hope that he is in fact a little louder, although that guy from New Jersey was pretty loud. Let's see what happens.
Hello, my name is Edward Gross. I am the managing partner at Gross & Romanek. You may learn more about our firm at gross.com. We handle a great deal of business transactions. This short video will be discussing the purchase and sale of the assets of the business. It is no substitution for legal representation. I will not be discussing the sale of stock or membership interests. Some acquisitions or sales of a business are quite complicated and are beyond the scope of this video. The first step in the process is due diligence. The buyer should examine the books and records of the business and should obtain written financial income and expense statements. The seller should have all of his books and records, especially the financial records, in good working order. Although the purchaser is generally not obligated to pay the obligations, the debts of the business, certain taxes and key vendors may have to be paid. I also recommend that the buyer work at the business for a week or two. The parties to the transaction should make a list of the assets that are being conveyed, which may include the name of the business, the phone numbers, inventory, equipment, and customer lists. If the inventory is being conveyed, you may need to send a bulk sale transfer notice. The buyer should do a record search to make sure that there are no liens or judgments against the assets, and also to determine that none of the assets are actually under lease. If the current location is important to the business, then review the lease and contact the landlord to see what arrangements can be made for the assignment of the lease. It is essential that a good written agreement be prepared by an experienced business lawyer. The purchaser and the seller have very different concerns and should have their own representation. Oral agreements are generally not enforceable. Some items that are included in an agreement are contingencies, such as financing or assignment of the lease, warranties, non-compete agreements, and default provisions. The final transfer of the business should be handled by a lawyer. The keys generally close the transaction. I hope this short video was useful to you. If you require representation, contact us at Gross and Romanek. Our number is 703-273-1400. You may visit our website at gross.com.
Admittedly, I think they got a very good website. Who wouldn't want that website, gross.com? Well, whether it's good for you or not, that'd be the last video of the whole semester. I probably should have found a better one, but I guess that is what that is. So those are the two kind of starting points on due diligence and ways that you may purchase the company, asset versus stock purchase. So now let's get a little more detailed on what due diligence is. First of all, from a perspective of a potential buyer, we're looking at the financials of a company. We're making sure we understand the market the company serves, as in its customer base, and all the technological issues and skills that that business has that you are considering the purchase of. It's clearly unwise to purchase a business that you don't know anything about their financials, their customer base, or how they produce or provide services. Most of us as engineers will have a head start on the technological review, even though we will generally not know every detail about somebody's processes. We kind of come with a starting point that would allow us to understand it. We covered a bunch of finance and marketing this semester so that you at least have some concept of those aspects of purchasing a business, whether that company serves a market that you're interested in that you feel is healthy, whether financially they've been doing well, and how to evaluate it, looking for problems that you might otherwise not see. We do this to establish the value of a company. We've talked about book value, for example, which is simply the difference between the assets and liabilities, and therefore the owner equity. That is a moment in time valuation that pays no attention whatsoever to the value of the continuing operations. A book value of a company is most suitable for a company that has stopped operating, and you're simply taking all of the remaining assets after the liabilities are paid, but you're never going to do anything with that business other than maybe sell off that equipment. So establishing the value of a company goes beyond just looking at the balance sheet, because establishing the value of a company is really looking at the cash flow from that business. How much is the owner earning as a result of managing that business? So for example, if a company is owned by a family, and that family takes $100,000 worth of income every year, that's one aspect of value of that company. If that family not only takes $100,000 worth of income out, but also pays all of their, private automobile insurance, their health care, all these kinds of things, these might also be considered as part of the value to a new owner. Whether that owner chooses to pay their car insurance or health care or whatnot the same way is almost immaterial, because we're going to look at the net income of the business, which is how much did it make after paying all its bills and including paying the owners their salary, plus the owner's salary, plus any of these seller related items that could have been more income or more salary had they chosen to do something differently. In the example I gave earlier, where the owner of a business is reinvesting in their house, that owner could have sold the business for more money had he paid himself $20,000 and then personally paid for, an upgrade to his house, than if he had the business pay for the upgrade to his house and paid himself less money. In this case, it looks like a required expense of the business and therefore a burden on the business, as opposed to paying yourself more, which would be a benefit of the business. So we're establishing the value of a company. There are a lot of ways to do it, but that generally involves using the balance sheet to assess the value of the assets and the impact of the liabilities, plus the value of the recurring income that comes from running that company. So the owner's salary plus the perks that owner is taking, plus the net income, etc. The other thing we're doing with due diligence is figuring out what it will take to actually transition from their ownership to your ownership. We're learning about the different processes and procedures. We're learning about the customers and how you advertise to them, the distribution channel, the vendors, everything. You're learning a little bit in due diligence about everything, so that when it's time, when you've agreed to purchase this business, you can establish a plan of action to effectively transition from the existing owner to your ownership without undue problems being hitting you. You're also, during due diligence, looking for problems that you wouldn't have seen or couldn't have seen when you are evaluating the financials of a business on a cursory level as you start to decide if you're interested in it. At least one of the companies I've looked at over the years to buy, from a financial standpoint, when I looked at the original data, it looked like they were doing okay. But when I looked at the day-to-day transactions and I could see into the checkbook, which is part of my due diligence at that time, I could see that on the one hand, the owners paid themselves, and then in very short order, they took that pay and put it right back into the company because it wasn't doing well. And they had done this for a while. So it looked like it was generating more income for the owners than it actually was. So finding a problem like that during due diligence immediately throws cold water on your interests because, well, why would you pay somebody to take the problems that they themselves have not been able to resolve? If you can't make that business make money for you, why in fact would I pay you to take it and try to figure out how to make money for me? If they were just wanting to get out from under it and gave me that business, that's a different statement. But in this case, they wanted good money for a business that wasn't making good money. And due diligence is the way you figure that out. The kinds of things that we do during due diligence, we're going to review a bunch of documents. First of all, we're going to look at the last 3 to 5 years of tax returns. We're going to see that the company has told the Internal Revenue Service, this is how many sales they made, this is how much it cost them to do sales, this is how much income they earned as a result, this is how much the owners paid themselves. It's a pretty strong synopsis of the financials of that business in a format that the IRS, the Internal Revenue Service, has actually had the opportunity to evaluate, and if there were problems, take action on. Generally speaking, a small business has about a 0.4% likelihood of getting audited, but there are an awful lot of flags that would cause a business to be audited. For example, not paying yourself, lending yourself money, bunch of things that make the IRS go, we want to see proof of what they're doing. So they're doing a little bit of your due diligence to start with. It's not wise to lie to the IRS. So we're going to start with the assumption that the tax returns are a pretty true representation of the business. Now, it's true that internal financials don't have to match exactly to the tax return, because in tax return you have some possible ways of, for example, depreciating items, some additional things where you can get tax credits, etc. So the tax returns and the internal financial statements may not be exactly the same, and that generally doesn't make them wrong. But the internal financial statements need to be reasonably close. If you said you made $1 million in your financial statements, the tax returns pretty much better be close to that. In the financial statements, you can look for trends in revenue. The tax returns are, obviously 1 year at a time. And most of the businesses we would look at to purchase are not going to be required to give quarterly tax returns the way a publicly traded company is. But in this case, annually. So what happened from last year to this year, it's all bets are off, because how it was presented for a tax purpose may be different than within the day-to-day, week-to-week, month-to-month operations of the business. So the financial statements, many cases something like QuickBooks or Peachtree, or however this owner is managing their day-to-day transactions will give you more detail on what's going on in that business. So you need to look at both the tax returns and the financial statements and look for disparity between them that would cause you to do more evaluation on certain items than others. We're going to look at the customer files. We want to see who the customers are, what are they, what's their trend been? Are they increasing or decreasing in purchases? Is it changing from, a retail, middleman kind of situation to direct customer sales? Things that would let us see how this company is working and also see how this company is changing. If a customer or a set of customers that used to buy $250,000 worth of goods every year have worked their way down consistently for the past 2 or 3 years, so that now they're only purchasing $50,000 a year, you need to start asking why. What is our offering being replaced with? And is this customer ultimately going to go down to 0 per year? And try to find out whether that will impact you. I mean, if it went to 0, it will impact you. But understanding what the current trend is and what the logical conclusion to that is important to you in determining whether or not to buy this business. One of the things we can look at are insurance claims. Does this business have a bunch of insurance claims, whether it's workers' compensation, product liability, business personal property damage, any of those kinds of things? What, in fact, is going on that you should pay attention to? Similarly with warranty claims, is the frequency of faulty product going up, going down, staying steady? And what does that mean to your customer base? If the number of warranty claims are slowly climbing, you can be pretty sure that the number of customers who go elsewhere will also climb. Not to mention the fact that warranty claims beget additional expense because you've got to either make the product again or make the product right and get it back to the customer. You're going to look to see, does this company that you're interested in have the proper licensing to actually be in business? From as simple as, did they apply for the business in their geographic region? So in Phoenix, for example, if you're going to sell goods at retail, your business license is tied to your sales tax license, and you're going to pay that every year. If you don't have that, there are other issues you may run into. But that's not the only kind of license. It could be licenses or permits associated with customer or industry requirements. So for example, you could look at ISO 9000 in the aerospace industry as an expense you must have, because the customers are going to look to that first to see that you have the quality systems in place to properly serve them. We're going to look at intellectual property rights. Does the company own the rights to their designs, or did they lease them or come to agreement to be able to make that product? because it's somebody else's design? And are those intellectual property rights properly protected? So we talked about trademarks and copyrights and patents, each of which have different processes by which they are protecting the owner's rights, also knowing that those are transferable rights. We want to make sure that something as simple as the name the company is using is protected. You don't want to purchase a company like the one that Eric talked about, Burger King or Little Burger King, and find out that you don't have rights in a specific area that you otherwise are doing business. So intellectual property rights are something that you would evaluate during a due diligence. As we move down this road, we're going to look at current customer orders and compare them to past orders. We're going to look at current orders from the vendors, things that the company is purchasing. Most commonly, you may find a change in what customers order, but more importantly, you're looking for big changes in how much customers order so that you can extrapolate properly, over the next few years, what's going to happen. When it comes to orders from vendors, things that the company is buying, you kind of want to know that something is on the way and that they're buying a suitable quantity. I think it was about 3 months after the purchase of my first company, a barrel on a pallet showed up with 11,000 pieces. 11,000 pieces means 11,000 lights. And if you're selling 100 lights a month, that's a long, long time before you have to buy any more of these things. So you're looking to see, are there any purchases coming in that are going to show up after you own the business that will still need to be paid for? Contracts is another thing that you would look at during due diligence. The phone service, the internet service, utilities, any leases for equipment, buildings, vehicles. All of these things can impact you. They don't have to. So for example, you might say, I'm not going to take over the lease for the, Mercedes-Benz that the owner is currently leasing, so that when you go to purchase it, you make it clear that I don't want the Mercedes-Benz and I'm not going to assume the lease of it. That's the existing owner's decision on what to do about it. When I first bought the lighting company, the owner had signed an agreement for 3 years worth of trade show space. Now, I'll tell you, he was halfway through it. I didn't know about it. And so I ended up going to 3 trade shows in the course of the next 18 months, at which absolutely nothing was sold. And mind you, every show probably cost us $7,500 to $10,000 because of the nature of the show and where it was. So you want to know if that sort of agreement is in place before you purchase a company. Similarly for advertising, he had a longer term ad budget committed to a lighting magazine that, again, really did a whole lot of nothing useful for the business. But that was in place, and you either had to take on that and continue that agreement, or find a way out of that agreement depending on how you purchase the business. Sometimes you have raw materials contracts, and sometimes employees have contracts, both of which you need to understand before moving forward. The odds are that you would need to and want to very much start a new contract if that's the way you intended to maintain employees. But as a minimum, have them cease employment by the prior owner and then be reemployed or employed by the new owner. That would at least draw a line in the sand where an employee who had an issue that wasn't properly addressed could effectively be assigned to the previous or the new owner and stay out of problem. I had at least one name on the list of employees when I purchased the first company that had been written up twice for harassment. And I simply made it a condition of the purchase that that employee no longer worked there when I took over. It wasn't going to be a problem that I would take care of going forward, but that the owner who hadn't effectively taken care of it would have to do. So employee issues, looking for poor performance, poor attendance, etc., harassment, is something you want to know before you purchase a business. You want to have done some kind of assessment of the inventory to make sure as you purchase this company or the assets of this company, you're not paying $10 each for something that is worth nothing because it's obsolete. You want to know that the equipment that you're purchasing is in serviceable condition. It's unlikely that you can or would expect everything to be in as new condition in an ongoing business that you're purchasing. But you surely want to know if the equipment you're buying is likely to break down the first week or 3 that you start to use it. And if there are spare parts that need to be in place, if there are maintenance that hasn't been done that needed to be done before you took over, this is a good time to make that a condition of the sale. When it comes to your competitive environment, knowing what's going on with your competitors is important as it is with your customers. So for example, is the owner selling the business because he's got a new competitor that he just doesn't think he can compete with? Possibly. He's got a competitor that is floundering and doing things that are destroying his market? Maybe. Are his competitors failing? And the reason for them failing just not quite caught up with the current business owner yet? Things that are going on around you become very important before finalizing the purchase of a company. Is there any legislation being considered or in the process of being approved that will impact your business? In the case of the lighting, we've experienced changes in the light itself, going from incandescent to compact fluorescent to LED. Some of that was legislated, as in Congress and the Senate passed laws that removed your ability to purchase certain lighting. And then clay specific, the reduction of lead in glazes became a major factor in the efficiency of those glazes. So for example, removing lead from a glaze dramatically impacts how effectively that glaze works and the yield. So maybe you got 8 out of 10 fixtures properly glazed before the lead was removed, down to 5 out of every 10 that worked well after the lead was removed. So those kind of legislation, changes in industry standards, etc., impact your ability to make money. And so knowing that they're coming is all important to you. Does that business have any outstanding tax obligations? You definitely want to know that. The IRS has this interesting way of coming in and closing your building and making it your problem to prove that you've done nothing wrong before they'll allow you to reopen it. They've done it to huge businesses. They have no compunction to do it to a small business. You'd like to find out what kind of unnecessary expenses are involved in the business as you see it. One of the businesses I bought, the owner purchased an RV for his parents and paid all the auto insurance for his children, and in fact was paying a salary to his ex-wife from the business. None of those expenses was I going to continue on, but it's important to know that they exist as you're figuring out the ability of that business to actually pay you for your work. And in fact, the ability for that business to fund future growth when you don't have to pay for those unnecessary expenses. The goal of due diligence is to make sure the company is first healthy. You don't want to purchase a company that is failing, and this is the time for you to do that final assessment because you have unfettered access to all of the company books, customers, etc. You want to determine the fair market value for this company, what someone wants for their business, and what you're willing to offer to purchase that business are rarely the same thing. The business we're considering at the moment, they wanted $375,000 for the purchase. And when we went through all the books, we said our fair assessment of this says that we'd be willing to pay $275,000. And they actually accepted that. So understanding what somebody wants and what somebody's willing to pay are not always the same thing because people look at them differently. It didn't make either the owner or the purchaser wrong, because what's important in those assessments are their personal valuation of an income stream, their personal valuation of the equipment. So for example, if somebody bought a forklift for $10,000, but you can buy a used forklift in just as good condition for $4,000, are you willing to pay the premium to that owner for their forklift? You shouldn't be. You should determine a fair market value for the assets of a company, a fair market value for the earnings of the company, and know that maybe an owner would like to get paid 5 years worth of net income, but the industry average is about 2.5 or 3. So those things very realistically affect the value of a company without being combative. This is also the time we're going to establish the expectations of the former owners and the new owners. So for example, in the purchase of a business, it's always important to have non-compete agreements so that the person you are buying the business from understands that they can't take all the money they just got from you and all of a sudden become your competitor. They have a history with your customers, what will become your customers, and you absolutely want to prevent them from going to that customer and saying, hey, I am going into that business again. I don't like the way the new owner is, managing what I built. Therefore, I'm going to come back into this market and offer you an alternative to what was my former company. You do not want to allow that in any way, shape, or form. Usually, those are geographic. So in the same state, same country, potentially, you can establish a non-compete agreement for a certain number of years. And that's an important feature of you buying a business and protecting it to the best of your ability. Perhaps when you purchase a company, you want to establish a period of time that you require the existing owners to support you after purchase. It may be associated with how you work with the customers, how you work with vendors, how you work with the processes, how you work with the employees, etc. But specify what you expect the former owner to do and for how long, so that that is part of your purchase agreement. If you are moving ahead with the purchase of a business, what are the conditions of the purchase? We will purchase this business provided that you sign a non-compete, provided you, being the existing owner, the prior owner, you will provide the training that we need. You will introduce us to your customers. You will, get rid of those problem employees, etc. Determine all of the things that are required to happen in order to purchase this business from them. It can include the contingency that you actually can get funding to buy it if you are borrowing money. It could be that you are purchasing it from this current owner through a combination of down payment and monthly payments, because sometimes the sellers are the financing agent. So determining conditions of purchase is one of the goals of due diligence. Your main goal is to make sure that if you take over this company, you've made sure you know enough about it that you can have it survive. You want to know that you know enough about the business that how they're doing it now, you understand, and you see some potential ways maybe to make it more profitable. So how you might manage it in the future is part of your goal here. Understand that it will survive with your management and that you're not making a big mistake. If you are financing this company, and probably even if you're not, you want to make sure that the profits can pay for any financing. It's unlikely that someone you're purchasing a business from will have the same loan amount and loan interest rate that you will. They may have the tail end of a loan that they had, or they may have borrowed money that you wouldn't otherwise borrow. But you are looking for The assurance is that if it ran as it is running today, it will generate enough profit to pay for any financing, pay for your salary, etc. Do you need to do this alone? No. You may want to enlist the help of an accountant. We refer to them frequently as the CPA or Certified Public Accountants. You may choose to have a lawyer review your purchase agreement and any contracts that are existing to make sure you understand the implications of them. For the most part, we are all engineers, so you may or may not bring in some additional engineering support to understand the process, to understand the equipment, make sure that it is in good enough shape. You know, are you skilled at figuring out maintenance that may be needed, or do you bring someone in who is competent in analysis of equipment just from a day-to-day maintenance perspective? So you may bring somebody in to help you with that. Do you have a clue as to how to market this company? Can you use some support from, you know, a sales, advertising, marketing firm to really jump up sales? There are things that you can use and do during due diligence that are there. They're available to help you. You don't need to be the only one trying to do this. You should recognize these as people you can hire on a short-term basis, or people who are interested in your future, as in the CPA may be willing to do an analysis of the financials for you and identify any scary things that maybe you didn't recognize, with the hopes that he becomes your accountant going forward. Similarly with a lawyer, usually they will provide you a small amount of free service in the hopes of getting your long-term business. So use those support personnel when you need it. Kind of the most important thing about purchasing a business and doing due diligence is to leave emotion out of it. We are go, no go. We do buy a business or we don't buy a business. It does make enough money or it doesn't make enough money. If you are just excited by this business and you skip some of these steps, that's when you get yourself in trouble. You need to put aside that instant gratification of being a business owner and put on your logic hat from your engineering degree. Is this a good idea? Is this not a good idea? Can I do this? Should I do this? Those are all important questions. But just because it's an interesting, exciting potential for owning a business, don't allow that to make you make a bad decision. Even when it feels like the right business, you have to make sure that financially the numbers work before agreeing to buy a business. The last thing you want to do is buy a business that can't pay you and that is fraught with problems that you didn't uncover or thought you could solve easily because you only decided to look at it by yourself. You didn't choose to get the help of the accountant or the lawyer or the marketing guy. You looked at the problem, you said, I can take care of that. And maybe you can, but maybe you can't. So even if it feels like the right business, make sure financially it's going to be there for you also. Do you guys have any questions
Professor,
Yeah.
will the final for this class be cumulative?
No. The final will cover only stuff from after the second exam through close of business today.
Okay, thank you.
Mhm.
Are you considering giving us any more freebie extra credit points, like for exam 2?
No, I gave you too many already.
Fair enough.
Oh, it's a hard enough semester on all of us that ultimately you guys have done on average better than past classes, and so I have no real worry about how y'all are doing. And the university has made a bunch of concessions, so I don't see why anyone needs any additional opportunity. I think that everybody here has pretty much got what they need. Anybody else?
Professor,
Yep.
do we need to bring, or are we allowed to use a calculator on the test, or is it going to be all through the lockdown browser?
I'm going to assess the way Lockdown Browser allows you the following things: calculator and a PDF that's going to have balance sheet and income statements that are used in the questions. I think I don't normally on an in-person test, I have a financial income statement and a balance sheet that you can refer back to based on the questions. I don't like the way the browser is, and I don't want that much data on every question associated with them. So I'm going to figure out the best way to do it. It may involve emailing you guys something that you have to print out, but I expect it to be something that you can access during the exam instead.
Okay.
Will we be using an equation sheet at all, or have you decided that we should just have that stuff memorized?
In your head. There are precious few equations, and in every case, the name of the equation gets you most of the way. So I think you guys are capable of probably memorizing the 4 or 5 where the names kind of make you go, what does that mean? As opposed to times interest earned. Can you figure out times interest earned? How much earnings did you make compared to the amount of interest you paid? Yeah, I think you can figure that out. You know, quick ratio, current ratio, they're not really telling you what they are, but those two are super easy to memorize. So plan on doing that little bit of work and keep that in your head for a long time to come.
So should we then expect an announcement before Monday with all of the information regarding the potential PDFs and what to do with calculators and whatnot?
Absolutely. I need to kind of test the situation before I assume that it works. This is part of the reason we did the practice test. I gave you kind of more extra credit than was appropriate for it, but I did it. It's done. I'm not going to back out of it, but I will make sure that those things work in a way that allows you guys to be successful as long as you put the time in that you need to.
All right. Thank you very much.
You're welcome.
Professor,
Mm-hmm.
could you unlock the old Canvas quizzes for us to review?
All the ones except for probably the ones from this weekend should be unlocked. I just haven't unlocked the ones that were due Sunday yet. But about the only ones that you technically have to look at Monday morning are from this week. Everything else should already be readily visible, or will be about to, because I do have at least 2 I've got to undo.
Okay, thank you.
Well, guys, I wish you all luck. I'm here if you still have a question. Have a great, safe weekend.